What is going on, YouTube? Welcome back to Death and Taxes. Today I'm going to be talking about the S&P 500. I'm going to be talking about the NASDAQ, inflation, all kinds of indicators. I've been seeing a lot of content lately where people are making outlandish bullish scenarios that I think are irresponsible, frankly. And I want to just look at the data and show you and discuss with you guys what the data is showing so that we can all make the best decision with our money that we can. And right now, there's a lot of people making comparisons and bullish cases that, and frankly, just don't make any sense to me. So let's jump in here. The S&P 500, I got SPY pulled up right here. And we can see, like, we're in a technical downtrend. We are putting in lower lows, right? We are putting in lower lows. 1, 2, 3, right? We actually had a close yesterday below the 100-week moving average, which is a very strong line of support historically for the S&P 500, historically speaking. There's multiple instances of us holding the 100 week. We wicked below it here, but ultimately held it. Didn't quite go all the way down here, but we ultimately held it. Held it right here as well. We zoom out, I mean, time and time again, we came down here, 2012. Again, later that same year. We came down to it in 2010, multiple times, in 09 as well. We wicked down to it. 2005, 2006, twice. Again in 07, and then finally in 07 we broke down below it, ultimately bounced resistance off of it, and then kept going lower. So look, there's a pattern playing out right now that has repeated itself time and time again. Okay, this is what bear markets look like, right? We put in an all-time high, put in a low, put in a lower high, we put in a lower low, and then we get a big dead cat bounce that it's the bull trap. It's what everyone thinks, okay, we're coming out of it now. And then it's immediately sold off and we end up putting in a lower low, right? The same thing happened in 2007 and 2008, right? We put in an all-time high. We went in a downtrend. We put in some of these lower lows here, had some big bounces. Right here, we broke above the 100-week moving average for a little bit, but ultimately the dead cat bounce ended up in a bear market, right? And this pattern has played out multiple times. Like if you look at the exact situation we're going through, where we've got a technical downtrend, we got a big bounce, we got a lower low, we got then a higher high where we actually went higher than this previous bounce, but sold it off and put in a lower low. That happened in 1994, right here. That happened in 1994. And this is the case that a lot of people in the media are talking about that they think that we're in right now. It's possible. Look, anything's possible. Nothing's certain in life but death and taxes. So, you know, I wouldn't take this argument to the bank, though, because, look, they had a 16.5% drop in the S&P 500. Okay. And the pattern is actually very similar. It's a steep downtrend. We had a big bounce. We put in another low. Well, technically that's the same. It's a double bottom, really. Arguably that's a higher low. But we put in a higher high, and I think that's the important part before reversing and putting in that lower low, right? And then all of a sudden the market switched and went on its merry way. And what happened right here in June of 1994? What happened there? June of 1994. The Fed continued tightening. The Fed continued tightening through this whole year, really, through the end of that year into 1995. However, the key difference is in 1994, inflation was low. Inflation was right at about 3% or below even for most of that year. So it was a different macroeconomic situation. They had fundamentally controlled inflation, unlike right now where inflation is parabolic at 8.5% and rising. Again, we'll get that number out shortly here, and we'll talk about that. Who knows? It could be lower. I have reason to believe it could be lower, especially with a lot of energy prices starting to abate or at least slow the rate at which they're increasing. So I think that could be helpful for that inflation number, but we'll see. So look, the key difference between 1994 is, yes, the pattern looks very similar to this so far, where we had those two big bounces and put in the lower low. However, the Fed was aggressively tightening, but inflation was under control. That wasn't their primary concern when they were reining in the economy. And we were also mid-cycle. We were early to mid-cycle in 1994. So we had a recession end in the middle of 1991. And look, 1994 is an early to mid-cycle for this expansion. So, there's a lot of similarities in terms of the technical analysis and the market structure, but I think that bringing in the big holistic macroeconomic picture is really important, and we can't rule that out. Inflation is a late cycle phenomenon. It just is. It means the economy has grown so much so quickly that prices are rising and going out of control, and supply is not able to keep up with demand. So we're in an inflationary period, which typically happens late cycle. And one instance of this is a very similar technical pattern, but in my opinion, this is a much sounder historical comparison in terms of the macroeconomic situation we were facing, was 1973. 1973 had a technical downtrend. We put in an all-time high at the beginning of that year. I know I talked about this on Monday, but look, we put in a low. We had a big bounce up about 10% on the S&P 500 that summer, sold it off, technically put in a lower low, put in a higher high on this big bounce, but sold it all off, and then it ended up turning into a bear market. And the interesting thing is it's very similar to how this played out, except the Fed tightened so hard in response to increasing inflation at the end of this cycle that they tipped the economy into recession, and the stock market just kept going down, ultimately resulting in about a 50% drop from top to bottom. So, when we're talking about the ultimate downside risk in the current macroeconomic environment, I would say the 1973 example is it. Because what was going on in 1973? We had spiking inflation that took us from below 3% to over 12.5% in 1975. So we had spiking inflation, we had Fed tightening, we had overseas wars, we had an energy crisis, and the stock market entered a technical bear market as the recession began, because the Fed tightened us into a recession. 1994, you just don't have all of those same situations. We don't have an energy crisis. We don't have high inflation. We don't have overseas wars. And we're early cycle. We're not late cycle. So I think the 1973 comparison is a much sounder one. Obviously, I would like for the S&P 500 to just bounce off this support level and keep going. I think what would need to happen for that to work out would be a pivot from the Fed. It would need to be a pivot from the Fed, and it would be CPI for May coming in below 8.5%, and then continuing to level off and roll over in June and July, as the Fed would then respond and pivot its rate hiking approach. I think that is what is necessary. I think that's certainly possible. I mean, we have a big sell-off happening in crude in May here, and it's been relatively flat. I mean, if not really down from its high in March. So that's certainly possible. However, there's a lot more that goes into CPI than just energy prices. So what I would be watching is I would be watching for the signs of the market pricing in a Fed pivot. So the dollar is still going parabolic. I mean, the dollar is just going through the roof. Cash is king right now, and investors are pulling their money out of the market and putting it into the dollar. And if you look also, pull up the 10-year Treasury yield. There we go. Here's the 10-year Treasury yield. So this generally follows the Fed. for the most part. This is our risk-free rate. This is what the market uses to determine the basis for mortgage rates, for all kinds of interest rates across the economy. And it generally follows the Fed, and it's continuing to go higher and higher. I've seen a lot of people draw these arbitrary lines here, you know, and pointing to RSI numbers on the 10-year. The 10-year doesn't care about RSI numbers or trend lines. The 10-year doesn't need to revolve around a median. The 10-year just follows the Fed and whatever the Fed is doing. If the Fed is going to continue tightening, then the 10-year is going to keep going up, right? So it's just, and honestly, I think it's a really disingenuous argument to make that just because the 10-year is technically overextended from its trend here, that it needs to come down. It doesn't need to come down. It follows the Fed. So ultimately, that's what I would be doing. I would be putting my money into cash with the dollar rising, and equities and crypto and bonds all losing value simultaneously. And I would be watching this 10-year. I'd be watching the inflation numbers that are coming out every month and seeing when is the Fed going to tighten, because ultimately that's your sign for when the market is going to start to turn around. Until then, our base case is really that we're in a bear market. And in bear markets, really quickly, this 100-week SMA that has been support for a decade, the better part of a decade, could become resistance. So I would be cautious here. Obviously, none of this is supposed to be taken as strict financial advice, but just be watching these indicators and making your own decision as best you can. And we'll continue providing you with all the data that you need in order to help you make those decisions. So if you like today's video, please smash that like button, smash that subscribe button. It really helps. Post your questions down in the comments down below, and we'll get to them when we can. Thank you for watching.